provision has been introduced to align the requirements of IFRS or Ind AS with the requirements of Companies Bill. So therefore, companies that follow Ind AS or IFRS will not be allowed to use security premium to write off all these expenses. And we all know redemption premium is nothing but effectively an interest cost. Now the question really here is, when does this apply? So when would these classes of companies be notified? Because Ind AS is not anywhere in the horizon. It probably will come 2 years, 3 years, or it may never come. We hope it will come in the next 2 years. So when are these classes going to be prescribed? If those classes are going to be prescribed immediately, then you would not be allowed, or it may not be possible for you to charge off your redemption premium into your into your security premium account. But if these companies are prescribed at a later date, when IFRS gets implemented or Ind AS gets implemented, at that point in time, this section would kick in. Now, we don't know when this section is going to kick in, and what we have recommended to the rulemaking committee is let this section kick in when Ind AS kicks in, because then it would be aligned to the intention of the legislation, which is to make this rule or make this requirement of Section 52 aligned with Ind AS. The other thing is, in the past, you were not allowed to reopen your accounts. Now, in the Companies Bill, voluntary revision of your financial statements is permitted. Now, if you look at the requirement of Ind AS, whenever you change your accounting policy or whenever you have a prior period item, you retroactively restate your comparative numbers. Now, therefore, as and when Ind AS comes and you have to change your accounting policies, you have to adjust your prior period item, you have to go for a voluntary revision, which would then mean that you have to go to the NCLT, and the NCLT will go to SEBI, income tax people, and so on and so forth, in a long process. So therefore, there is a great difficulty, in my view, in implementing Ind AS if the voluntary revision of financial statement includes changes in accounting policies and adjustments of prior period in accordance with Ind AS. So there is a big issue there. Interestingly, Section 243 of Companies Act, they define free reserves very, very interestingly, and it says that free reserve does not include any amount representing unrealized gain on revaluation of assets. So if you have a translation gain, if you have your foreign exchange debtors which you are translating and you have a gain and you have recognized in your P&L account, that is a reserve, but as far as Companies Bill is concerned, that is no longer your reserve because of the definition, which says that you can't take anything that's unrealized. And this could even mean that if you have certain huge provisions on uncertainties and you reverse those provisions, it's unrealized gain, and therefore you can't recognize that into your free reserves, though you would be crediting those things in your P&L account. As you can see, there is a big difference growing between the institute and the government, and that is quite visible from the setting up of the NFRA, which not only is a body, standard setting body on accounting standards, but also auditing standards, and has huge, wide powers to debar audit firms, and it can debar audit firms for a period of 10 years. So there is an enormous amount of authority that's been given to NFRA. Now, on the audit rotation, I think the big issue here is whether the audit rotation requirement will apply retrospectively or it will apply prospectively. So let's say you have an auditor that's been in doing your audit for the last, whatever, 10, 20 years. So if you believe that this provision applies retrospectively, effectively it means that you have to rotate your auditor in the next 3 years, which is the transitional period. But if your interpretation is that the rotation rules apply prospectively, then the auditor rotates after 2 5-year terms, which is after 10 years. And there are people who believe that the auditor rotation would happen 10 years plus the 3-year transitional period. So you don't have to rotate your auditor for the next 13 years. Now, the people who are assuming a prospective application of the rotation principles, they do so on the basis that you can rotate your auditor only if your auditor has completed 2 5-year terms under the bill. In the past, he has never completed 2 5-year terms. He's always completed 1-year term over 10 years or 20 years or whatever. So therefore, they believe that prospective, the prospective interpretation is to a great extent possible under the bill. So unless something happens in the rules, this again will be a big issue, and how people are going to interpret this. Again, very interestingly in the bill, if you see, they have considered the concept of network firm for the purposes of prohibited services, but they have not considered the concept of network firm for the purposes of rotation. So therefore, within a network firm, if there are two firms which do not have common partners, the company can theoretically or even practically under the bill can rotate an auditor from, let's say, S.R. Bartley Boy & Co. to S.R. Bartley Boy & Associates, because these two firms do not have common partners. But I think there the institute will come out with network rules which will prohibit you from doing that. But under the bill, you could actually do it. Again, to a great extent, huge amount of responsibilities on auditor, and that has an equal impact on companies like you, because whatever the auditor does is with regards to his client and to his companies. And as I keep saying, that the only thing that they have not done for auditors is capital punishment. Otherwise, every damn thing that could have been done has been done. So auditors to report on fraud, and to the central government, irrespective of considerations on materiality. And not only frauds that have happened, but that are also in the process of happening. And so therefore, the auditor is expected to become a Sherlock Holmes. Auditors reporting on internal control has been significantly widened, and internal control is just not financial controls. Internal controls have been defined in the bill, in the director's responsibility statement, saying that internal control also includes efficient and orderly conduct of business. So auditor has to see that the business has been conducted efficiently and orderly. And auditors are also supposed to look at financial transactions and whether any financial transactions have adverse impact on the functioning of the company. So if a huge group has acquired a company, and if that company is making losses post-acquisition, would the auditor be required to say that this is a financial transaction that has an adverse effect on the functioning of the company? So there seems to be a judicial overreach as far as the auditor's responsibilities are concerned. And again, we have made significant representations to the committee that's drafting the rules to kind of make things more specific rather than to leave it so nebulous, because when you leave it so nebulous, then you are exposed to harassment in the future. Just last one or two slides, Naushir. On CSR, obviously there is an issue of jurisdiction and constitutionality, and whether somebody can really charge 2%, whether the government has the ability or powers to charge 2% under the bill or under the act. So there are constitutionality issues, and therefore CSR is in a sense not legally binding, or is not made legally mandatory, and that has an accounting consequence. Because if you are a company that's spending irrespective of the legal provisions, then you may not have a legal obligation, but you may still have a constructive obligation. And under current accounting standards, if you have a constructive obligation, you don't necessarily have to provide those expenses in your financial statements. In other words, those expenses get accounted in your financial statement on a cash basis. As in when you spend, you charge your penal account, so you don't provide for it. Interestingly, on the CSR, private companies are not required to have independent directors. But if they are companies that fall in the CSR provisions, if they have turnover more than 1,000 crore and so on and so forth, they have to have a CSR committee on which they will have to have independent directors. So while private companies are not required to have independent directors, because of the CSR provisions, they will need to have independent directors. Lastly, on related party transactions, it's been very badly defined. It's been very badly defined. So for example, even the term relative has not been elaborated. So typically, an auditor is supposed to remain independent, not only he himself, but also his relative. So if your mother-in-law does not like you, all that she has to do is to buy a share in the company that you audit, and you get disqualified as an auditor. So there are these big holes there. And if you see this definition here, it says any company which is a holding, subsidiary, or associate company is a related party. So therefore, typically, if you have parent P and associate A and associate B, as far as parent P is concerned, associate A is a related party. But as far as associate A is concerned, parent P is not a related party. And neither is associate A and associate B are related to each other. So therefore, they have not really understood the concept of related party from whose perspective, and the fact that related party is a concept based on reciprocity. So if A is related to B, B has to be related to A. But the way it is defined, it would not turn out to be that way. And the other thing with related party is they're saying that if there is a related party transaction, the related party is not supposed to be voting on that transaction. But again, which related party and from whose perspective? So if you have a subsidiary S and a parent P, and subsidiary S has to pay royalty to parent P, it is quite clear that parent P would not be allowed to vote. But it is not clear whether there is another investor which holds 20% in subsidiary S will be allowed to vote or not. So related party from whose perspective and who is not allowed to vote. Again, some of these fundamental issues are not clear.